In less than 48 hours, Asia opened red, and the metal complex paid the price in a way most traders only see once in a decade. 6%. Hong Seng slid roughly 2%. 1%. At the same time, the safe corner of the market didn't behave safe at all. 4% on the latest leg. That's not a normal pullback. That's a forced reset. And here's the part that breaks expectations. The selling didn't look like a slow change of mind. It looked like a chain reaction. One market gap led to another. One risk limit hit led to another. Liquidity thinned, spreads widened, and suddenly, assets that usually move in different rhythms started moving together for one simple reason. When leverage snaps, everything becomes the same trade. You sell what you can, not what you want. They said this kind of dislocation couldn't happen in modern markets. They said metals were too deep, too liquid, too institutional to see a double-digit drop that fast without a major crisis. Yet it happened anyway, and it happened while the narrative was still being written. By the time most people heard Asia opened red, the mechanics had already done the damage. Because the real story wasn't just the red candles on a chart. The real story was in the plumbing. Open interest, margin. The hidden rules that decide who can stay in a position and who gets pushed out. Those rules changed in real time, and when they changed, the market's behavior changed with them. What I'm about to lay out isn't a rumor, and it isn't a conspiracy. It's a pattern you can measure. It shows up whenever the market's balance depends on borrowed conviction. It shows up whenever the crowd is on one side and the price moves just far enough to turn confidence into liquidation. And once you see it, you start recognizing the same playbook across decades, across assets, across regions. Welcome to Signal and Steel, where we decode what matters before it becomes a headline. If you've ever felt like the market explains itself only after it's too late, you're in the right place. Subscribe the way you'd keep listening to that calm voice who notices the details everyone else ignores. And drop a comment with where you're watching from, because this channel is built for people who want the story behind the price. Now let's reconstruct what actually happened, step by step, with the numbers that mattered. On Monday, February 2nd, 2026, the session began with Asia leaning risk off. The red open wasn't subtle and it wasn't isolated. It was broad, the kind that suggests allocation decisions rather than a single headline scare. As equities slid, the first assumption many viewers make is that money should run into defensive assets. But metals didn't follow that script. They sold with the tape. 8% to $45.15. 4% to $73. Oil fell more than $2 in the same wave. This is where the central mystery starts, because the usual story says metals should catch a bid when stocks are bleeding. The answer is that fear isn't the only driver. Funding is. When portfolios are stressed, the first priority is raising cash and reducing volatility, and metals are one of the fastest ways to do both because their futures markets are liquid and their leverage is efficient. A fund that needs to cut risk can dump a block of metal exposure in seconds. That's why these moves often begin in the overnight hours and then accelerate. During Asia's trading window, the book is thinner than peak US hours, and the price can travel farther before it finds a real wall of bids. The move then becomes visible across time zones, and once it is visible, another layer kicks in: systematic strategies. Trend systems, volatility targeting, and simple stop-loss rules start to reduce exposure because their models don't care about opinions. They care about realized movement. If volatility expands, position size contracts. If a trend breaks, exposure is reduced. The selling becomes less like a debate and more like a math problem being solved in public. So what changed? Not sentiment in the abstract. The change was structural. The cost of holding positions rose, and the ability to carry leverage shrank. After the plunge, CME raised margin requirements, 8% for heightened risk, 5% for heightened risk. The timing matters. Those increases were set to take effect after Monday's close, meaning anyone sitting on thin capital had a clock ticking. You either bring more collateral, reduce exposure, or get reduced for you. That's why the price action had that falling through floors feel. When margin rises, the market doesn't ask for your opinion. It asks for cash. And when a lot of participants are on margin, the cash demand doesn't come in gently. It comes as forced selling. That selling pushes price lower. Lower price increases paper losses. Losses increase margin stress. And that loop feeds itself until enough positions are gone that the system can breathe again. If you want proof that this wasn't just casual profit taking, look at open interest behavior. COMEX gold futures. Open interest was reported at 488,001 contracts, down 23,319. Yet volume was still massive at 639 on 156 contracts. That combination is a fingerprint. High volume with falling open interest usually means positions are being closed, not rolled. It's liquidation, not a healthy rotation. Even in equity derivatives, you could see the same kind of de-risking. Nikkei 2 and 25 yen futures open interest was reported at 83,311, down 52,130 contracts. That's not a retail crowd. That's large exposure being cut fast, under constraint. Now, this is the moment where experts start contradicting each other. And both camps can sound convincing if you only look at price, but the plumbing tells you which story fits the tape. When open interest drops sharply while volume stays elevated, the market is ejecting passengers. When margin requirements rise after a plunge, the exchange is acknowledging volatility and protecting the clearing system. In plain language, the casino just increased the minimum buy-in because too many players were overextended. That doesn't tell you the game is over, it tells you the game got dangerous. To understand why Asia opening red can accelerate this, you need to think about time zones and the relay race of risk. Asia sets the tone. Europe reacts. The US either confirms or fades. But metals trade almost continuously, and metals are a favored arena for leverage because the contracts are efficient. That efficiency is a gift until it becomes a trap. When the first wave of selling hits during Asia's hours, liquidity is thinner than during New York's peak. Stops are closer, market depth is lighter, and once price gaps, the next layer of orders triggers automatically. And once that slide begins, the next question is always the same. Who gets margin called first? The answer is rarely the biggest institutions. The biggest institutions build their exposure with multiple layers: futures, options, OTC swaps, physical inventory, and hedges that offset timing. The ones who get forced first are the leveraged directional participants who depend on stable volatility, the ones who used yesterday's calm to justify today's risk. That leads us to the hidden historical pattern. Because this exact sequence has played out before, and when it does, the headlines are always different, but the mechanism is the same. Volatility spikes, margins rise, open interest falls, and price overshoots to the downside. Then, once the weak hands are cleared, the market either stabilizes sharply or reverses violently. Not because the world changed overnight, but because the forced sellers are gone. In 2008, you saw a version of this in commodities broadly. Deleveraging didn't discriminate. It sold oil, sold copper, sold precious metals, and sold equities, even though the story behind each asset was different. The result was a cascade that ended only when balance sheets were repaired and leverage was reduced. In 2011, silver gave a cleaner, more concentrated example. A parabolic move met a series of margin changes. As the required collateral rose, the air came out fast. The outcome wasn't just a price drop, it was a shift in who could participate. The market became less forgiving, and the leveraged crowd got replaced by participants with more staying power. In March 2020, the pattern resurfaced in a new disguise. The world was staring at a public crisis, but the market's behavior was a funding crisis. Even gold sold off in the initial panic because people needed dollars. The outcome was an initial liquidation, followed by stabilization, as policy responded and liquidity returned. Now in 2026, the setup rhymes again, but with a twist that matters. The trigger wasn't an obvious catastrophe. It was a repricing of policy expectations and risk limits, with a narrative flashpoint around the Federal Reserve. The nomination of Kevin Warsh as Fed chair became the kind of catalyst that markets can latch onto, because it changes the implied path of rates in people's minds. Whether that repricing was justified is almost secondary to what it did to positioning. A stronger dollar narrative, a tighter policy narrative, and a sudden change in what's priced in can pressure metals quickly, because metals are sensitive to real rates, to the dollar, and to the cost of carry. When that sensitivity meets leverage, the repricing doesn't arrive as a gentle drift, it arrives as a shove. But here's where it gets interesting. If this were purely a fundamental story, you'd expect orderly repricing. You'd expect open interest to hold steadier as participants reposition. You'd expect volatility to rise. But you wouldn't expect the exchange to raise margins immediately after the drop unless the move itself threatened stability. The margin decision tells you volatility wasn't just expected. It was realized in a way that demanded a rapid change in collateral rules. And once margins rise, the market creates a new class divide. There are participants who can post more collateral without blinking, and there are participants who can't. The price often moves to the point where that divide becomes visible. That brings us to the dislocation, the part that looks like two different realities. On one side, paper prices are collapsing. On the other side, the slow-moving indicators that reflect the physical world don't always confirm the same urgency. Look at base metals as an example of how confusing this can get. 92 a pound on January 31st. That's a clear growth scare signal. Yet, Shanghai Futures Exchange copper warehouse stock was reported at 233,004 tons, up 7,067 on the week, which sounds like supply building rather than scarcity. So, which is true? Is the world drowning in metal, or is the world short metal? Both can be true at different time horizons, and that's exactly why dislocations appear. The paper market prices the next 2 weeks. The physical market is built around quarters and years. When leverage forces the paper market to dump exposure, it can temporarily price a reality that the physical world hasn't had time to reflect. That's not comforting, but it is clarifying. And precious metals are even more sensitive to that split because the paper market is enormous relative to immediate deliverable supply, and because a lot of participation is financial rather than industrial. When financial conditions tighten, the financial layer moves first. Let me make the mechanism simple with an analogy. Imagine a theater where most people bought tickets with a credit card, and the theater suddenly announces that anyone who bought a ticket on credit must pay a larger deposit by tonight or give up their seat. The show hasn't changed. The seats haven't changed. But the financing terms changed. So a crowd rushes to the exit, not because they stopped wanting the show, but because they can't meet the new deposit requirement on short notice. The exit gets crowded, people bump shoulders, a few fall behind, and when the doorway clogs, panic spreads through the room. That's a margin squeeze. In markets, the deposit is margin, the credit card is leverage, the exit is liquidity, and the crowd doesn't leave in an orderly line. The crowd leaves at market, hitting bids and pushing price lower until enough seats are empty. Now, tie that back to the exact numbers we saw. Gold margin moving from 6% to 8% sounds small until you scale it. On a large position, that's a 33% increase in required collateral. Silver going from 11% to 15% is a 36% increase. If you're running a leveraged book, you don't just feel that. You must fund it. And funding is never just about having money. Funding is about timing. If the requirement takes effect after Monday's close, the market knows there will be selling. Pressure ahead of the deadline from anyone who can't or won't post more collateral. That anticipation can front-run the pressure. Sellers sell early. Liquidity providers widen spreads. And the move becomes self-fulfilling. The opening red is the spark. The margin mechanics are the accelerant. Now let's talk about the players, because institutions do not all behave the same, and the timing of their actions leaves clues. Exchanges like CME are not trying to predict price direction. They're trying to keep the clearing system stable. When volatility spikes, they raise margins. That action is automatic in principle, but discretionary in speed and magnitude. A margin change is an institutional acknowledgement that recent moves exceeded the comfortable range. And it is a message to participants, either reduce leverage or increase collateral. Meanwhile, large banks and commodity trading firms monitor these changes constantly. If they see margins rising, they know which counterparties are most vulnerable. They know which strategies depend on stable volatility. They know which funds are likely to reduce exposure, and they can position to provide liquidity or to exploit forced flows. This is not coordination in a dark room. It's coordination through shared constraints. Everyone sees the same rule change, and everyone knows the weakest balance sheets tend to react first. At the same time, asset managers with longer horizons watch liquidation events like hawks, because they can create mispricings. They don't need to rush into a falling market, but they do watch for the moment the forced selling exhausts itself. That's why liquidation events often end abruptly, not softly, abruptly. The selling is not distributed evenly through time. It's concentrated around constraints. Once the constraint bites through enough positions, the flow disappears. So how do you recognize the exhaustion point without guessing? You watch the same plumbing that told you this was liquidation in the first place. If open interest stops falling, or if it falls at a slower pace, that tells you the forced exits are slowing. If volume remains high but price stabilizes, that suggests absorption. If spreads tighten after widening, that suggests liquidity providers are stepping back in. If volatility begins to compress after spiking, that suggests the market is transitioning from panic to auction. You also watch the cross-market tells. In this episode, Asia's equity weakness was a broad de-risking signal. Oil dropping more than $2 added to the sense of macro pressure. Copper's decline reinforced the growth scare narrative. If those markets begin to stabilize while metals remain weak, it suggests metals have their own internal forced selling still underway. If those markets continue lower while metals stabilize, it suggests the macro impulse is still present, but the metal-specific liquidation is clearing, and the weakest hands may already be gone. That's why the dislocation matters. Two data points can tell opposite stories at the same time, and the market can be right in both directions, depending on the horizon. Now, what does this mean going forward, not as a prediction, but as a historically grounded map? Historically, when you see a margin hike paired with a sharp open interest drop, the market is in a regime change. The next phase usually presents three broad scenarios. The conservative scenario is stabilization through time. Price stops falling, volatility cools, and the market grinds sideways while participants rebuild positions at smaller size. In this scenario, the dramatic move is mostly behind you, but the aftershocks can last. The key indicator is whether open interest begins to rebuild without price breaking down again. The moderate scenario is a reflex rally. Once forced selling is done, price snaps higher because shorts cover and liquidity returns. This can be fast, because the same thin liquidity that amplified the decline can amplify the rebound. The key indicators here are a sudden improvement in market depth and a reversal in intraday behavior, like higher lows and strong closes after early selling. The aggressive scenario is a second leg down triggered by another funding shock or another margin response. This happens when volatility remains elevated and the exchange or clearing system tightens further, or when another correlated market breaks and forces more cross-asset liquidation. The indicators to watch are renewed widening of spreads, another surge in volume with another sharp drop in open interest, and weakness that spreads from paper pricing into physical indicators more visibly. Notice what's missing from those scenarios: certainty. The point is not to declare which one will happen. The point is to understand that the path is shaped by constraints and flows, not by vibes. So what should you watch in the next sessions? Watch whether margin changes create a visible deadline effect. Watch the next open interest prints. Watch whether volume stays elevated. Watch whether the dollar remains bid on policy repricing. Watch whether Asia continues to open red, because repeated weak opens can signal continuing de-risking from systematic strategies. And watch whether base metals, especially copper, confirm or reject the growth scare. Because if copper stabilizes while silver continues to bleed, that tells you the silver move is more about positioning than macro. If copper collapses while silver stabilizes, that tells you macro pressure is intensifying, but the metal-specific liquidation is clearing. If both stabilize together, that tells you liquidity is returning. If both break together again, that tells you the deleveraging loop still has fuel. And this brings us to the real divide in markets, the part that separates people who get blindsided from people who stay calm. It's not intelligence, it's not access to a secret newsletter, it's attention to the right layer of information. Most people watch price and then chase explanations. Institutions watch constraints and then anticipate flows. Retail moves last because retail watches the surface. Institutions move first because institutions watch the plumbing. When the exchange raises margins, institutions immediately map who must sell. When open interest collapses on high volume, institutions know this is not a gentle rotation. When multiple markets move together in a way that violates their normal relationships, institutions know the driver is liquidity, not narrative. And the wealth gap that grows in these moments is often an information gap. The data is public, but the interpretation is rare. One more tell is the curve. When front-month futures lose their usual premium and the spread whips around, it signals inventories and financing costs colliding. Calm curves mean orderly hedging. Violent curves mean participants are paying to exit now at any price. If you take only one thing from this episode, take this. When safe havens sell off with risk assets, the market is telling you it is short liquidity. That's when the rules matter more than the stories. That's when the exchange notices volatility and changes the terms. That's when open interest becomes more informative than any commentator's confidence. This is signal and steal, where we decode what matters before its headlines. If this connected dots you hadn't been seeing, you know what to do. Because the question isn't whether markets move. The question is whether you understand why they moved before the explanation arrives.